welcome to the Corrective strategy course. Thanks for being here, and I hope you get some value out of the whole program as it go along. Essentially, this is going to be a short presentation just going through the rules. This is a strategy which I've developed over many years of trading. I've picked up stuff from multiple different mentors over the years, but this is something that I've really created by myself as a combination of what I've learned from others, what I've learned from reading and resources, and what I've learned from most of all watching the market, spending hours and hours a day trading full time for different companies, different institutions. So this is something which I've created over time, and I'd say it's truly unique in that I don't see anyone else teaching this. I don't see it's not a commonly taught strategy or an idea, but it's built around a concept which I've also built up over the years trading. So it's something that you can either learn to trade exactly the rule-based system which I'm about to teach, which you could trade that, just follow the rules and trade it, or you could also incorporate some of the concepts or the ideas or combine it with your current ways of trading. I think this is something that multiple different traders can get value from and learn something, a slightly different approach in the market. In the name, it's the Corrective strategy, so we're trading corrections, which I will go into. Let's get into some of the rules. I'm going to go through the strategy rule by rule, and then further down the line in following videos we're going to go through loads of different examples so you can see this strategy in live trading as well as pre-recorded examples or back testing as well. So first of all, what is it? It's a mechanical trading strategy. So what do I mean by mechanical? It's a rule-based system. So it means it's not like a discretionary strategy. It's not, if it does this, a breakout, we might do that, we might not do that, we need confirmation, all that kind of stuff. It's not like that. It's fairly straightforward. Anyone can learn this. It's literally, if A happens and B happens, then do C and C to D. For example, it's if that happens, then when we do this. What I love about mechanical trading, I've come to love it over the years, it takes away a lot of the stress and takes away the uncertainty. Majority of traders fail because they don't have a plan, they don't have a system, they don't have a set of rules. They are continually trading in a messy way, or it's something that I'm guilty of in my trading career, is taking too many trades. I used to trade every setup I could see. I'd be trading breakouts, I'd be trading reversals, I'd be trading retracements, Wyckoff, Elliott wave, everything. It's a combination of so many different things, trading fundamentally, trading off order flow. You can almost have a death by knowledge in trading. You can see so many setups that you just get lost. And then what happens to your trading data is you've got no real understanding of what your win rate is, or you've got no real sort of plan to go off or data to go off, because every trade you take is a different trade, a different setup, which then makes it quite hard for you as a retail trader to be successful. If you're an institution or you're in a bank or something like that, it's a little bit different because they're trading off information mainly. They've got algorithms, they've got data, they've got analysts, they get all the news early, they know where all the orders are in the market, they can see the order flow. If you're a retail trader, you haven't got any of that. You've just got your laptop, your internet connection, and you're at home, you've got your PC at home. So we need to find other ways often to find an edge. And the markets do trade very technically, they do trade very statistically, and there's ways we can take advantage of that, and we can take advantage of probabilities, because this is a probabilities game at the end of the day. We want to take advantage of probabilities that are likely to happen, more likely to happen than not happen, and do the same thing over and over again. And secondly, consistency. So this is why mechanical strategies are so good, because they help you be consistent, because you do the same thing every time. And if you just do this strategy every time, or you do any strategy any time, you just have a set of rules and you follow that, you'll have very clean data to look at, and you can see exactly where you should tweak the strategy to improve it. You could be journaling the strategy as you go along, which is going to really help you as well. So what this strategy does, essentially in a nutshell, it trades reversal setups. So kind of reversals as well as retracement legs. So the majority of traders out there, they trade retracements as a continuation trade. So they wait for a strong move, then they wait for a pullback, and then they get in and for a continuation trade. What this is doing, this is trading the leg after that. So the actual corrective move. So where a lot of traders might be getting in for a continuation, I'm actually taking the other side. This move takes advantage of when the market is overextended. After we've had a strong move up, we've had a shallow retracement, and we've had an extension, and it's taking advantage of when the market is vulnerable to a correction. And this is, combined a little bit with Elliott wave theory about impulses and corrections and things like that. But it's a clear pattern in the market we can take advantage of. In terms of risk to reward, you're looking somewhere between 1.5 and 2.8, but this does have quite a high win rate. You're looking somewhere between 70 and 80% win rate if you follow the rules correctly. So there is potential here. It's not as affected by risk to reward as other strategies might be. Higher risk to reward but lower win rate strategies. This is more on the other end. And lastly, it works on any time frame. So it doesn't matter if this is a 1 minute time frame, a 5 minute, daily, weekly. You can trade this any time frame because markets are fractal, meaning that markets have the same behavior from a price perspective on any time frame. Each time frame is like its own universe, and they follow the same sort of concepts and principles from a price action perspective, from a price perspective as well, from the movement of price. Let's go forward. So why does it work? First of all, we're entering in liquidity levels and liquidity zones. So we're getting involved in the market at its most interesting time. A lot of traders are getting in when it's not interesting, when the market's not at these key points. But at the end of the day, the market always wants to go to where there is liquidity in the market. It wants to go where there's going to be traders and banks and institutions and deals to be done. It's going to go to the price where people stop out and where people get in. That's the market. It's driven by algorithms now, as well as institutions. It's always going to these points of interest, and that's where we want to get active in these areas. What we're essentially doing, we're getting in where a lot of people are either stopping out, or a lot of traders are getting in on the other side to me, thinking it's a breakout, and we're actually trading a reversal. We're also looking at the technical structure when it's vulnerable to a correction, when it's overextended, when it's a bit fragile and gone a bit too far on a statistical basis for what normally happens. The market doesn't travel in a straight line. There's always waves. There's always people take profits, the market corrects a bit, people get back in for the continuation. Then you have these corrections where the market goes too far, people take heavy profits or sellers come in, price crashes down quite fast, and then we either have a recovery or we have a continued reversal. That's essentially what we're doing. We're looking for these key areas and this high probability chance of a correction, rather than trying to catch the whole move or catch the whole swings. Here's a couple of examples, fairly straightforward. As I said, we're looking for impulses. This strategy is all about the impulse, and the impulse is a term I think comes from Elliott waves, but it's really just a psychological interpretation of strength in the market in one particular direction on any time frame. What impulse leg is essentially telling us is that the buyers, in this case, the buyers have come in, and the buyers are stronger than the sellers, and the buyers are sucking the liquidity from sellers. They are just buying them up. They're buying all the offers that the sellers have, bidding up the market. If you imagine the market as a ladder, like you have in the futures market, there'll be bids all the way up as the market goes up, and the bid is just taking the next offer and taking the next offer. And in particular markets where you have a strong move, sellers are pulling their offers, they're pulling their orders. So then, the next price that might actually trade from here could be 10 pips higher, and that's why you have these explosive moves in a matter of minutes, because everyone pulls their orders. So actually theoretically trades from this price to this price. So one order's filled here, then another order's filled there. Well, it won't be one order, but this is not always in the candle that every price gets traded. We don't have access to that information because the FX market is decentralized. Or if you're trading CFDs or spread bets or things like that, it's all decentralized. So you can't see the order flow like you can in the futures market or the stock exchange. If you're trading FX at a bank or certain institutions, then you can get access to dark pools and liquidity, and you can see where liquidity and where orders are. But as retail traders, most of us don't have that, so we've got to go off the price action, and the price is always showing us a story. It's always showing us the battle between buyers and sellers. So that's why we're looking at impulses. We're looking at impulse because that's where the interest is. And now when the impulse has made a high and it's retraced, the interest is now above that high, above that impulse. This is where people are going to get in when it breaks out. This is where breakout traders are going to come in, and this is potentially where others are going to come in to trade the fake out, or the institutions or the funds or who want to, if you're a hedge fund and you want to put a massive position on, for example, this is not going to apply to every setup, but let's just say you're a fund or you're an execution fund or whatever it is, and you need to execute a certain amount. You need to execute 200 million in a certain currency pair, or 500 million or a billion, and you know that if you do that all in one clip down here, you're not going to get filled in much of it because the market's just going to absolutely crash. You're only going to get a partial fill, and you're going to be having to chase the market down, and other algos are going to come in, HFTs are going to come in, and you're not going to get much of your order filled, and you've actually pushed the market further away. So a lot of these big funds and institutions, they need the liquidity to put their position on without being detected. So breakouts, when breakout happens, break above the levels, that's perfect for them because they get access to all this extra liquidity, because you have retail traders, you have breakout algos, you have people stopping out. So buy stops, it's buy stops essentially. Anyone that's short down here, they're getting stopped normally above the high. So this is a little pool of liquidity basically, where that hedge fund can just, their sell order, you can use things like iceberg orders where the market can't see them, and they just get absorbed above this high, and they just absorb all the buyers with their massive order, and then eventually there's not any more buyers and the market will start to come down. So that's kind of a little bit of the ideology. It's not, obviously it doesn't work like that every time. This could be a setup on a 1 minute chart, and it might not necessarily be a hedge fund trying to do a trade on a 1 minute chart. I'm not saying that. Usually they trade on a slightly higher time frame potentially, depending if they're manually executing or if they're doing algorithmic trading. The market has patterns, and these things happen over and over again. They happen time and time again, and we want to take advantage of these patterns, these probabilities. And I've back tested this strategy all the way back to the 1990s, and you can find setups there, and you can even go further back than that. So this is something that works based on psychology. So after we had the extension, this move is quite extended. You've had a strong leg, and we've had another leg, and we have barely any retracement in between. So we know it's vulnerable. This level is vulnerable, and again, there's liquidity under there. Again, it's almost like a trick move. You get the move up, then the move down. So people get screwed on both sides. They get stopped out. Anyone that's long, they get stopped below there. Anyone that's short gets stopped up there, and it's just like kind of catching everyone out either side, as the FX market always does. And then you either, you have these continuations often after these corrections, or you have an actual reversal. Sometimes this setup manifests as a reversal setup as the high of whatever time frame it's on. And to the right we've got a bullish version of a setup. So it's not always a short setup, there's a long setup as well, exactly the same thing. Strong leg down, retrace to 38.2, extension to our rejection level where we get in, and we have our stop down here, and we have our target here. Back for the correction. As you'll see, in this case this is more of a reversal setup, and I think it actually continued from here. But again, we're not trying to catch the whole move, we're not trying to predict the market, we're trying to take our slice. It doesn't matter how small the slice is on the chart. If you can consistently take a slice each day or each week and each month, and do that consistently, then we're going to be consistently making money from the market. And that's all we're here to do, really. I think too often as traders we get caught up trying to be right all the time and trying to get every move and every bit out of the market, and we want to get everything, and we get upset if we leave everything on the table. But you can't think like that, because it's a never-ending cycle. You'll always be annoyed at missing things, and you just got to remember as well that there's always new setups, like all the time. If you miss a setup, you could take another one will come. So on to the first rule, as I said, to break it down, we looking for impulses. So we want to see these strong candles with virtually no wicks, only tiny wicks. Now ideally these like Marbuzi type candles with no wicks at all. It just really shows you that the buyers or sellers are fully in control. This is the key. Without the impulse being right on the strategy, this strategy won't work. If you just take a strategy with small price action, it's too slow and it's steadily going up, it won't work. You can't take those trades. This is about correcting off of fast moves. Often these moves, they can be news, they can be data, and the market just goes too far and then it gets corrected. It can almost sometimes be like an inefficiency, like it's just gone too far. It's extended too much on information that wasn't necessarily true. It's more speculation. This is the start. This is the key bet. We need to see big candles in these legs up. This is a leg down. This is a leg up. On to rule 2. We need a shallow pullback. So after we've got our strong leg, we need it to pull back to 38.2 maximum. All right, we can give a bit of room if it spikes it a little bit. Doesn't really matter. Occasionally I will take the 50 in very rare circumstances. If it comes to the 50 but some other criteria is met, I will take the trade. But majority of the time, just focus on the 38.2. That will provide the best opportunities. And also 30.9. So if it comes to 30.9, it's still valid. If it doesn't, so if it was just come to here then went up, I wouldn't take the trade. It needs to ideally come, within pip or two of 30.9. Otherwise, it's too strong. If it's not too shallow, if it comes to like here and then just rallies from there, no, I don't want to be selling into that. That move's not really finished yet. It's going to continue going. You just need to be aware of that. There's a sweet spot. This is the sweet spot here, 30.9 to 38.2. Rule 3, extension. So after we have a leg and after we have a retracement, we need to see the market extend and make a new high or a new low. We need to see new structure formed. So this is a lower low, and we got a lower high, and then we got a new lower low made. So we want to see new structure made, and we want to take advantage of a potential for a snapback above this. So this is a great trade setup, buying at that rejection level. Majority of the time it will either come to rejection or the counter trend. Again, this is like the sweet spot. We don't know which one it will go to, so I always take the rejection. And you need just, I'll go into stops in a minute, but you need to stop at least below the counter trend to give yourself that room. This is an example here of a 50%. It's a rare one. I remember this trade. It was quite a while ago on GBP Swiss. I just remember it being a particularly nice one. Getting in. It's a nice feeling when you you pick the high and you have barely any drawdown and you just watch it go in a very short amount of time to your target and you're out and you're done for the day. And that's what I like about this strategy. Depending on what time frame you do it, obviously if you just take this strategy in a weekly, it's going to take a certain amount of weeks, but in terms of numbers of candles to hit your target, generally not very many. So it's a great strategy to get these sort of sniper entries. Obviously it's not going to work all the time. There will be drawdown periods or losing days or losing trades, but again, that's part of trading. If you can't handle losses at all, then I think you're in the wrong game. So yeah, that's the example of the extensions and rejections. On to the stop loss. Where do you put your stop? As I said before, the minimum has got to be the counter trend, but yeah, as you see in this example, it's not going to hold. You're going to get stopped out here. This wick goes all the way to here. So you actually need it ideally above the 38.2, which is the next level above. So there's multiple levels, which we'll go into. We'll go through so many examples as this video series goes on. But again, yeah, so you want your stop above the counter trend at least, but ideally above the 30.2 to give you enough room for when it overextends. Normally, the further it overextends, the faster or the deeper the correction. But in this case, it was a nice correction. We've got a nice slice from here to here. Lastly, target. Where are you getting out? As I've touched on already, you're getting out at 38.2. If you just want to follow the rules properly, just get out at the 38.2 every time. But there's times where you can scale out a trade, as I will go through in some other videos, where you can actually scale out a position, and your entry is always a rejection. Majority of the time I'm just getting out 30.2, but you can take 50% off here and either run it down to 50 or run down the half to the low. So on this particular trade, I managed to run the other half all the way down to the low, which is nice. You take 50% of your profit, you put your stop break even, and then you run the other half down to the low. And as I mentioned, this one, it went all the way to 30.2 exactly, and then from there it reversed. So it does happen. So it helps to have your stop above the 30.2. give you a bit of room in here, and then when these deeper reversals happen, maybe you can use this alongside some other signals. This market was, I believe, it was quite a big range at the time, and this had broken the top of the range, which was another signal. We've broken up into a liquidity zone, but it was just a fake out. A fake out's always been my trade of choice, if you will. I love getting in when I've just seen the fake outs happen so many times. I just like getting in on where the majority people are getting in the other way, or the majority of retail traders, and they just I like fading the market, to be honest. Yeah, this provided a very good opportunity to actually run the trade and get some more out of it. So yeah, just to summarise, we're looking for a strong move on any time frame, some aggressive price action. We want to see a shallow pullback, maximum of 38.2, between 38.2 and 30.9. We want to have an extension of 12.72% of the impulse leg. That's the rejection level. We want to have a stop above 38.2, and we want to have a target at the 30.2 leg retracement. Quite simple, but if it's not all sticking together yet for you, then keep following along. There's going to be lots and lots of examples, live examples, pre-recorded, some live sped up screen shares, so you can see it in live action. And the more you practice this strategy, the more you back test it, the more you look for these setups, the more it will start to stick in your brain, and you'll start to build those neural pathways, and you'll start to see it on your charts. You'll start to see them everywhere. In the beginning, they look a bit alien. When you learn a new pattern or a new setup, you don't see them as often. But the more and more you do it, the more and more you see it. So I'll see you in the next video.